Welcome to this explainer. If you follow the resource sector, you already know that commodity prices have been on a pretty fascinating ride lately. But what really matters is how a company actually leverages those market conditions on the ground. So today we're taking an objective, detailed look at the financial and operational data from Alkane Resources' third quarter of 2026, a quarter that the company itself is calling its strongest ever. Let's get right into it.
Here's our agenda. We'll kick things off with their record-breaking quarter, then tour the Tomingley, Costerfield, and Bjorkdal operations. After that, we'll look ahead to FY 2026 and wrap up with some important disclosures and your comments.
All right, Section 1, a record-breaking quarter. Just look at the sheer scale of this jump. We're talking a staggering $93 million in profit after taxes. To put that into perspective for shareholders, that represents earnings of 6.81 cents per share. That is a massive leap, and honestly, a very clear indicator that their operations are just firing on all cylinders right now. That profit? Well, it's stemming from an equally impressive revenue figure, hitting $274 million for the quarter. Now, it's absolutely crucial to note why this is so high. It's heavily fueled by an average realized gold price of $6,315 per ounce. It's literally a textbook example of capitalizing on highly favorable market conditions.
Managing Director Nick Erner actually hit the nail on the head in the report. He points out that these results are directly tied to the combined power of their expanded three-mine portfolio during this period of high commodity prices. So this wasn't just a lucky quarter, right? It was the result of a very specific structural strategy, scaling up to 3 mines, meeting the right market conditions at the exact right time.
Now, before we drill down into the specific numbers for those 3 mines, let's quickly clarify a term you're going to see a lot today: gold equivalent ounces, or AUEQ. Because Alkane produces both gold and antimony, they need a way to measure their total production value simply. AUEQ just combines both of these outputs into a single, gold-based measurement based on current market prices. It just makes comparing the overall value of different mines so much easier for us. Another critical metric we'll be looking at is AISC, or All-In Sustaining Cost. This is a vital number in the mining industry. It simply shows us the comprehensive cost required to produce each ounce of gold, while also factoring in the capital needed to maintain the current mine operations. Basically, it tells us not just what they're making, but how efficiently they're making it. So, out of the record 44,669 ounces of gold produced this quarter, the heavy lifting was done by Tomingley at nearly half of the total production, supported really strongly by both Bjorkdal and Costerfield. This is that 3-mine portfolio strategy perfectly visualized in action. Moving on to Section 2, Tomingley Gold Operations. Let's start our tour in New South Wales. Tomingley was the undisputed powerhouse of the quarter. They moved an incredible 338,000 tons of ore just to generate those 21,652 ounces of gold. And importantly, they achieved an all-in sustaining cost of $2,444 per ounce. That leaves a very robust margin when you consider those realized gold prices we discussed earlier. The big question is, how did Tomingley achieve this? Well, this high performance was driven primarily by strong ore grades from the Roswell underground site. But operationally, a massive win was the strategic insertion of a rental mobile pre-crusher. By pre-crushing the material before it entered the main processing circuit, they successfully boosted their milling rates to roughly 1.3 million tons per annum. That added efficiency actually drove their AISC lower compared to the exact same quarter last year.
Section 3. Costerfield Gold Antimony Operations.
Heading over to Victoria, Costerfield is a totally different beast because it's a dual commodity operation, producing both gold and antimony. In Q3, they produced 10,584 ounces of gold and 377 tons of antimony. Calculate that out, and it results in 11,691 gold equivalent ounces. And they achieved all of this with a very respectable AISC of $2,521 per equivalent ounce. Now, the source report does note that Costerfield dealt with some unexpected grade variability in certain mined areas. But here's what you should really take away from this. It's all about how they compensated. Their raw mining and milling rates actually exceeded planned figures, keeping their overall output steady. Plus, the site is actively focused on optimization programs right now, like transitioning to emulsion explosives. That's a move specifically designed to improve recovery rates and reduce dilution moving forward. Next up, Section 4, Bjorkdal Gold Operations. Crossing the globe to Sweden, let's examine the third pillar of Alkane's portfolio. Bjorkdal delivered a really solid, consistent quarter,
They mined over 246,000 tons of ore, adding 12,433 ounces of gold to the total portfolio. You'll probably notice their all-in sustaining cost is higher than the Australian operations, sitting at $3,699 per ounce. But, it is still well below the current realized gold prices, so it's contributing positively to the overall corporate margins.
Their strategic focus this quarter was a bit different. They intentionally poured resources into capital development activities over standard operating development in certain areas, ensuring the long-term health of the mine. They also saw a higher contribution of ore from below the marble mining area. And notably, they ran a highly successful trial processing off-site ore from a smaller nearby mine, which could definitely open up some very interesting blending options in the future.
Which brings us to Section 5, looking ahead to FY 2026.
With a comprehensive understanding of the Q3 data, what does the report indicate for the rest of the year? Well, driven by these strong operational results across all three mines, the corporate outlook remains incredibly positive. The company closed the quarter with a very robust cash, bullion, and investment balance of $374 million. With that kind of financial bedrock and operational momentum, management states they're completely on track for the year.
Here's exactly what that full-year guidance looks like. Alkane expects to produce between 149,000 and 161,000 ounces of standard gold, alongside 750 to 850 tons of antimony. When you combine all that, they're guiding for between 155,000 and 168,000 gold equivalent ounces for the entirety of FY 2026. And crucially, they estimate their consolidated all-in sustaining cost across the whole portfolio will hover comfortably between $2,600 and $2,900 per equivalent ounce.
Finally, Section 6, Disclosures and Viewer Comments.
Before we completely wrap up this explainer, we do have a quick but important legal disclaimer. Please note that this breakdown is strictly an objective, informational summary of the Alkane Resources Q3 2026 financial report provided in our source materials. This explainer does not represent financial, investment, or trading advice, and we are absolutely not making any buy or sell recommendations regarding the company's stock.
All right, that brings us to the end of our deep dive. We've laid out the data and the operational strategy spanning from New South Wales down to Victoria and all the way over to Sweden. Now, it's your turn. Jump into the comments and let us know what you think about Alkane's three-mine portfolio strategy. Is this multi-asset approach the best way to navigate the current commodity cycles? Share your thoughts below. And thank you so much for joining us for this explainer.